Any decent multifamily house in Minnesota starts at a minimum of $400,000, and 20% of that will be a down payment of $80,000. I do have $20,000 in savings. The question is, do I need to wait until I save the remaining $60,000, or is there an alternative to start my real estate? So thank you again for your questions. There are a couple of ways to go about this. So the first one is to consider a FHA loan. And for an FHA loan, you will typically need something between 3 to 5%, depending on the lender. And the one caveat with doing that, with using actually that type of funding, is that you're gonna have to live in the property at least for 1 year. So you can, I'm not sure if the intent was to get a duplex or a triplex or maybe a 4-family. So what you can do is that you rent out whatever other units are, whether it's 1, 2, or 3, and then you have to reside in one for at least 1 year. And then you have the choice to refinance out of it, because the expectation is within 1 year, you have paid down some money with your mortgage payments. And at the same time, you will hope that the market has appreciated over the years and potentially give you some sort of like a cushion in terms of equity, and then you can actually use that to complement or to build up something that could be allocated as a down payment for the refinance out of it. So hopefully that sort of makes sense. It's a great strategy to get started. The second one, if you don't want to do the FHA round, is to leverage services like Fund and Grow, where they offer you the ability to apply for business credit. So in this case, business credit cards. And the beauty about it is that you will simply keep your debt, quote unquote, on the business credit card separate from your personal credit. So as you're taking money out, you are not putting your personal credit at risk of going down, because it's something that's kept separate in a different bucket. And they have actually helped multiple investors to achieve up to $125,000 in funding. So they're known for getting credit card applications approved to you by the bulk. And I think they do that in batches of like every quarter or so. I'm not sure if they actually changed their approach, but last time I checked, they do that every quarter or every 4 months, depending on your credit profile, because that has a lot to do with it. So that's one. And the third approach that I would recommend, but this is a little bit more advanced, will be to leverage some sort of creative financing. So you can actually put down whatever money you have saved and then ask the seller to carry the remaining amount of money that you would need for the down payment. So for example, in your case, you said you have up to $20,000 saved, and the required down payment will be $80,000 if you were to go through a traditional mortgage. That means you will need $60,000 as a difference. So the seller could probably put down that $60,000, and then you will work with the seller to put a promissory note in place. And if you don't know what a promissory note is, it's basically a contract, kind of like an IOU, where you're making a promise to repay that loan that was given to you. You've seen that in the banks. The banks give you promissory notes. You promise the bank that you will repay them back in 15, 30 years mortgages. That's basically what that means. So the terms, the interest rates, you're gonna have to determine that with the seller. Typically, those are shorter terms, and what a lot of people like to do is that they do 1 to 5 years financing for the first 5 years. So you do all payments throughout 5 years, and then the last payment is a balloon payment. So the first monthly installments are usually interest plus a little bit of like the principal, and then you do a balloon payment. And then if you're wondering how you're going to take care of that balloon payment, you could do it either Fund and Grow by taking a bunch of business credit cards, or you can just simply refinance the existing equity out of the house at that point in time within 5 years, and then you just repay the seller in one lump sum. So hopefully that answered your question.